Last week, we saw, starting on my birthday, Powell come out and basically confirm that a 50 basis point increase, most likely multiple, are on the table. These are on the table. What does this mean? This means that a 50 basis point increase to what they would call the federal funds rate, 50 basis points. It is currently sitting at about 0.33%. Okay, with a 25 basis point increase. Now, before COVID, we were sitting around 3 to 3.5%. Okay, so that is about 1,000 times higher than what we are currently. Why did they lower rates? Because they needed to jumpstart the economy. And I'm going to jump into that in a second. Now, the reason we're pulling back now, one of the many reasons, I mean, nobody knows exactly why everybody sells, but one of the reasons is not just inversion on yields and not just that, but also the China lockdowns again. So we've got the Russia-Ukraine going on, we've got rates going up, and now today, this weekend, we saw that China is expanding lockdowns. Now, you might say to yourself, well, Saki, didn't that happen in 2020? And we priced that in, right? Sure. Well, Saki, that was about a 20% drop, and that was global shutdown. This is just China, so shouldn't we already be there? Big difference this time, okay? Number one, Shenzhen lockdown, which is where a lot of our products are made. Then Shanghai lockdown. And I'm talking about crazy lockdowns. I'm talking welded shut in your house. I'm talking robot dogs and drones with speakers on them telling people to stay in. People starving in their houses. People going to re-education camps who decide that they want to protest against this. Older people dying because they can't get to hospital. There's a lot of stuff crazy going on right now, right? Now, they're going into lockdown. They've already locked down Shenzhen. They're locking down Shanghai, 26 million, and now it's starting in Beijing. So now you're talking about a massive potential supply chain backlog again. And you're like, well, Saki, just buy the dip, right? Last time it went like this. That's where this comes into play. Last time, this rebound was not a natural rebound. This was a bridge made out of cash. Cash printed by the Federal Reserve. Saki, the Federal Reserve doesn't print money. It is a saying, okay? The Treasury prints money. But where does the Treasury get its credit to print from? Where do banks get their money from? It goes back to the central bank. So, back to rates. So a lot of people said, okay, we're pricing in a 50 basis point. We're expecting as many as 7, because remember, the Federal Reserve meets 8 times a year. So they priced in 7 increases with the potential for 1 or 2 50 basis point increases. 0.5% increases, right? So if you're talking about 7 of them at 0.25%, or 5 of them at 0.25%, you're talking about 1.25% plus an additional 0.5 to potential 1. So you're talking about a 2.25 plus the original 0.0. So we're talking about a 2.5% end of year is what kind of everybody priced in. And that's kind of why we were kind of hanging around there between 440, 460. We got the 450. We were kind of hanging out, right? 2.5% at the end of the year. That's manageable. Still cheap money. People can still, take money and do things with it. Okay? What happened last week? The week before, when Powell talked, he said we're going to have to start tightening our rate numbers, right? We're going to start tightening this up. We're going to have to start making sure that we're putting more of a hard break on this. Then he all but confirmed the 50 basis point and alluded to, which originally we had alluded to a 50 basis point. Now we're alluding to a 0.75%. Now the market, because Bullard keeps coming out and saying, oh, we might need a 100 basis point increase. With Powell all but confirming the 0.5 basis increase, we're now pricing in higher. If before he was kind of confirming 0.25 with a potential of 0.5, we priced in that. Now he's saying it's all but confirmed 0.5, potentially 0.75 at 1 or 2 of them. So now we could be seeing 3 to 3.5% end of year. Okay? Why does this matter? Why does this affect the economy? All right, real quick. Federal funds rate, okay, sitting right between, this was 2020, 2019, 3 to 3.5% here. Rates all the way down to almost 0. Why does that matter? Well, rates are the amount of money that banks borrow money from each other, right? So when banks, they need money for whatever, whether it's taking out capital, whether it's writing mortgages, whether it's investing, whatever, a bank will often borrow money from another bank at a rate, right? Oftentimes they go at what the fixed federal funds rate is. And in this case, it's almost 0%. So they're like, oh shit, that's cool. All right, yeah, I want to, you know what? I've got Microsoft. They said that they want to take out a loan for $250 million at, 0.25%, right? cheap money. And they're going to take that, they're going to hire people, they're going to give bonuses out, they're going to research, they're going to buy up another company. So this bank was like, all right, cool, we have that. Here you go, cheap money. And they're like, hey, thanks. We're going to pay a little bit of interest here, but we're going to keep it. And now Microsoft, okay, takes all that money and hires new people and expands different departments. And now these new people have jobs, so they go out and they buy cars, okay, and they buy houses and they go to restaurants and they eat and everything's good. And then this right here, this new division needs to get materials. So now they got to buy stuff from here and here and here, and everybody's making money, and it drives the economy, right? The economy scales. We're doing this. Okay, you might, you've got consumers that now take out a credit card. Instead of having a 25%, rate, they've got a 10% rate, meaning they can spend more money and they can drive the economy. Everything's great. Everything's good. But the problem is now you have too much of that going on and inflation starts going up. And so the Fed is like, oh shit, we've got to stop this. But we don't want to stop it because we don't want to stop the growth of the economy, but we need inflation to be at our target of 2.5%. It's currently sitting at 8%. So what do? We press on the brakes because we're going too fast. And so now what the Fed does is the Fed starts raising rates, which causes more money to be more expensive, meaning less borrowing happens. It slows down spending, which in turn slows down potentially inflation, but also slows down growth and slows down some of these businesses. So you're seeing a lot of stocks dip because these companies aren't going to have the same amount of money. And if they do, they're going to have to pay more. And then they're going to take out less loans. They're going to less hiring, less buying. It's the intention to slow this down. Problem is we've got so many other issues going on right now. Supply chain problems. We've got a war going on. We've got China lockdowns. And that's where this goes. Now, you might say to yourself, well, then banks are screwed. Well, no. They can also do what we did, we talked about 2 years ago, which is, reverse repos, where they can basically go to the Federal Reserve and say, hey, we need some cash real quick at a cheap rate because it's too expensive with the other banks. All right, we'll give you some in exchange for some treasuries. Here's some money that you got to pay back tomorrow. So that is the importance of rates right now. It basically, the Federal Reserve isn't in charge of making supply and demand and inflation and stuff like that, but they can and they do have tools to alter the federal funds rate, okay, which is in turn the amount it costs to borrow money. The more borrowing, the more spending, the more growth. But in this case, it's driven inflation. So they're trying to do it, but the problem is they want a soft landing, and they're getting to a point where they may have outpaced themselves already on inflation. They may have to make a hard landing or a hard stop. Now, if they would have started reducing the balance sheet November, October of last year and started with their 25 basis points now, it would have been a softer landing. But they were still having to deal with the job market and everything else, and they were hoping that inflation would be transitory. They retired that word. I'm pretty sure the next word they're going to retire is soft landing. So do we go to recession or do we go to stagflation? That's the question. Very few people are pricing in a glorious rebound. You forgot about T.I.N.A. Well, once again, T.I.N.A is very important, but not as many people are in T.I.N.A as it used to be. And for those of you guys who don't know, T.I.N.A is there is no alternative. And this is why we saw equities continue to run. Retail had money, people had money, cash was worthless, banks weren't giving out any interest, and there was nowhere else to go. Housing market was too expensive, commodities were too expensive. Everybody just put it in equities, especially spec stocks. I think T.I.N.A is still in play. I think it's in divvies or divvy stocks. And I posted something in the Stockies random info for you guys today that the highest performing stocks in the S&P 500 this year all have a divvy. Whether it's 1% or 8%, the highest performing, 19 of the top 20 performing stocks in the S&P 500 this year to date, are divvy stocks. The other thing is, and there's a lot of risk on right now, big time, is for gold. Gold is lagging behind because of the dollar right now, but this might be a sleeper right here. Now, you might say to yourself, well, Stocky, where should I put my money? What if I don't want it? You could always keep some in cash. And a lot of people, and we're about to get back to the trial, but a lot of people are looking towards real estate in 2 years. Why do I say 2 years? Remember what we talked about with the federal funds rate and the rate increases? This doesn't happen overnight. This doesn't happen overnight. It takes a while for the ripple effect to take place, just like a supply chain, right? The rate goes up and then it takes a while to ripple through all the sectors and all the different commodities, all the different, supply and demand. And this is obviously without the wild card of the war and the China lockdowns. So what could this do? Well, part of raising rates and making money more expensive is it causes mortgage rates to go up. Because remember, the federal funds rate affects everything from what you pay on your credit card to your car payment. It's how much it costs to borrow money. Mortgage rates, and you guys remember 2 years ago, I was screaming at you to get refinanced, dropped to an average of 3.25% 2 years ago, and now it's 5%. Stocky, it's only 1.75%. That doesn't seem like much. On a $300,000 house, that's another $122,000 that you'll pay in interest over the course of 30 years. So if you waited 2 years, it's going to cost you an additional $122,000. But what does this mean? We're seeing it the real estate side, and actually real estate's still going. Housing starts and builds and permits are still going up. But if it's more expensive to mortgage a house, there should be, in time, it takes a while, less demand to buy houses because it's not as cheap to buy houses. If you're calculating your costs and your mortgage payment goes up by 25%, that's going to price some people out. So if we eventually get to a point where mortgage rates are 5 to, 7, let's call it 7 for some reason, 7%, we could see a hard stop on that massive demand, which could, in fact, drive housing prices down. How much? I don't know. A lot of people think there's going to be a housing crash. I don't think so. I think that the people that have money or are making money are still going to buy homes because this is about to be a renter's market and everybody wants to own something that they can make money on, and they want to buy homes to rent out to people that are never going to be able to afford to buy. But in the next 1 to 1.5 years, I wouldn't be surprised to see housing market cool off significantly. I wouldn't look at it as a crash, but I would definitely would not be surprised to see housing market cool off in the next year to year and a half. So for those of you guys who are on the fence about buying a house right now, especially with mortgage rates so high, you may have an opportunity to wait it out a little bit. Obviously I can't see the future, but that's something that I would look. And that's kind of that's what the idea is around all spending, is that, credit card goes from 10% back to 25% up, and it costs more money to borrow money from bank to bank, right? They don't get that cheap rate. So now they're like, well, fuck it. Instead of paying, 3% from bank to bank, we'll just give, 0.75% savings account, which will in turn drive a whole bunch of people who have an emergency fund that they don't want to invest, but they'd like to make something on, to put their money in here. And then while your money's sitting in there, they're just taking your money, and for 2.25% less than they'd be charged from the bank, using your money to do everything they would otherwise with a transfer. So a lot of stuff like that. So that, ladies and gentlemen, is the concern with China's lockdowns and why it's different now because of rates going up at the same time, and what interest rates are, what the federal funds rate is, and how they work.